Hey everyone, Coach Investor back to another video for today. So in today's video, I want to cover three companies, three dividend-paying companies that are pretty stable even if we go into a recession in 2024. Fears of a recession are again making its way into the headlines. We know that we're going to get some rate cuts in 2024, but maybe that might be already too late because interest rates have been going up extremely fast and extremely high compared to what it was a couple of years ago. Now, these companies and plenty of other companies as well can be named as recession proof. Why is that? Because they sell products you will need to buy, doesn't matter what happens. Recession, inflation, depression, deflation, you name it, they will sell no matter what. Now, of course, there are plenty of other companies out there that you can put in that same category. If you own one of those companies, do let me know down in the comments below. Now, with those companies, there's one company, and that's the first one I want to cover. This company has been hit much harder than the others, and there's a reason for that as well, and that's the Hershey Company. Now, the Hershey Company is down. The stock is down close to 20% year to date. Now, you're going to tell me, yeah, but this is not really a necessity. Correct. Chocolates, stuff like that, snacks is not a necessity. But it is selling you food, it's still selling you snacks, it's things that you will buy no matter what if you really wanted to. Now, with regards to valuation here, you can clearly see that we have come down quite a lot since May. In May, PE in the next 12 months was 28.1 times. We're now sitting at 18.5 times compared to its mean of 23.4 times in the last 5 years. EV to EBITDA, also lower than its mean. Price to sales, 3.2 times compared to 3.8. And then the only one that is pretty close to its mean is the price to free cash flow, 22.9 times compared to 23.5 times, but that's in the last 12 months. Now, the Hershey Company currently has a market cap of $37.27 billion. But when you buy a company like that, you can see that the company is buying back its shares throughout the year. You can also see that free cash flow per share has gone up throughout the years. And then if we look at the EPS estimates with 5-year growth rates here in the next 12 months, sits at 8.3%. How does that compare to what the analysts are expecting for this company? Well, in fiscal year 2023, the expectations here are sales to increase 7.9% and EPS to increase 11.8%. For fiscal year 2024, we see sales increase just 3.5% and EPS just 5.5%. In 2025, things are basically remaining flat-ish with regards to the growth. So sales increased 3.6% and EPS increased close to 6%. So of course, you're not buying here a double-digit growth company, but it's a company that will be stable throughout the years and it is paying you a 2.62% dividend yield. And if we look at the dividend here, its annualized growth in the past 10 years, you can see 9.44%. So basically, if you bought 10 years ago, you would be getting 48 cents. You're now getting $1.19. Quite a nice increase. As for the analyst price target in the next 12 months, the average price target sits at $212, which means this is a difference of 16.5% from the price we're at today. Now, of course, with Hershey, the last time we've talked about that is because of a short report saying that Mr. Beast is coming for their business, there's increased competition, stuff like that. Fine, okay, I still don't think that a huge company like Hershey is going to take such a big hit right now from Mr. Beast Feastables. The big hit they're taking is the price of cacao, which, as you can see, has increased quite a lot in the last year. If you go down here, you can see this is real-time price changes. So as you can see here, cacao has increased 71.6% in a year. If you look at sugar, that has increased 2.48%. So those are the two main ingredients that will hit a company like that and all of its competitors as well. And this is what's putting extreme pressure on this type of companies. Some say that this might have a negative effect or will continue to have a negative effect in 2024. And this could lead to the following. If you needed a small reminder, these are basically the brands that Hershey is selling. And if you're familiar with the term shrinkflation, it's basically selling you the same product but a bit smaller and maybe even more expensive. Things that have already happened throughout the years, whether you're buying a Mars bar, Twix, you name it, things have become smaller and yet more expensive as well. Some say that this might happen with products that Hershey offers and their competitors as well going into 2024 and onwards if the price of sugar, cacao remains pretty high. But Overall, this company is going to be very, very stable for the years to come. The price of cacao will come down, just like the price of other commodities we've seen come down and peak throughout the last 2-3 years. And so I've put this in the list for this video. It's a company that will still be around for years and years to come, providing a lot of returns for shareholders as well. And if we go into a recession, I still think people will buy its products. Now, before jumping into the next company, if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Now, company number 2 is a company that is actually much stronger, much more recession-proof, and that's the Procter & Gamble company. It has a market cap of $344.5 billion. Year to date, it's basically flat. It's down just 1.11%, pays a 2.57% dividend yield. Now, if you look at the valuation metrics here, price to earnings, EV to EBITDA, price to sales in the next 12 months sits below its 5-year mean, not as discounted as the Hershey Company, because again, this company is much more stable. Doesn't matter in what environment, economic environment, macro environment we are in. But here as well, you can see that throughout the years, this company is providing shareholder value, buying back a lot of shares. Free cash flow per share has increased throughout the year. And here as well, we're getting approximately 7.8%. This is the estimated EPS 5-year growth rate, 7.89%. If we look at the dividend growth in the last 10 years, annualized growth of 4.77%, but in the last 3 to 5 years, we were closer to 5 to 6%. Again, in the last 10 years, if you bought 10 years ago, you get 60 cents. You're now getting 94 cents. As for the analyst price target, the average price target sits at $164, which means they're seeing 12.44% upside in the next 12 months. And this leads me to the analyst expectations for the next coming years. So sales growth of 3.6% in fiscal year 2024, with EPS growth of close to 9%. Then moving on to fiscal year 2025, sales growth of 3.7% with EPS growth of 7.5%. In fiscal year 2026, they actually see an acceleration in sales, 4.25%, with EPS growing 7.8%. Now, with Procter & Gamble, why is this extremely recession-proof? Well, look at the products that they're selling, whether it's baby care, fabric care, family care, you name it, feminine grooming. They sell it all. All of these products are under the Procter & Gamble name, and these are products that you will buy no matter what the macro environment, and this is why this makes this a company that you buy and you hold forever, because it doesn't really matter what happens. Even in the most difficult times, you're going to buy products that they are offering because it's just part of your life. These are essential products, which makes this an essential holding in your dividend-paying portfolio, in my opinion, of course. Do share your thoughts down in the comments below. Up next, number 3 is a company where you can maybe put it in the middle between the Hershey Company and between Procter & Gamble, but maybe a bit closer to the Hershey Company because it's not selling you baby care or stuff like that, and that's PepsiCo. Yes, we've talked about PepsiCo before, but I still think it can provide a lot of value to shareholders, especially in the long run. Currently, it has a market cap of $200 and close to $35 billion. Year to date, it's down 3.8%. If you look at PE in the next 12 months, EV to EBITDA, price to sales, it all sits much lower, quite lower than the last 5-year mean. Price to free cash flow is basically flat in the last 12 months compared to its 5-year mean. And PepsiCo is paying you 3% dividend yield. If you look at the shares outstanding, this as well has been decreasing throughout the years. Free cash flow has been a bit of a cycle here. As you can see, back in 2016, we peaked here with free cash flow per share. In the last couple of years, we've seen it go up. Of course, for this year, we are a bit down, but the year is not done yet. And then looking into the future, the 5-year growth rate here for EPS sits at 8.42%. If we look at the dividend growth throughout the year, in the last 10 years, the annualized growth is 8.13%. Again, if you bought 10 years ago, you got 57 cents, you're now getting $1.26. If we're looking at the average price targets from analysts in the next 12 months, the average sits at $188, which means they are seeing 11.35% upside in the next 12 months. Now, why is that? Let's look at the analyst estimates. For fiscal year 2023, sales growth of 6.7% with an EPS growth of 11.29%. In fiscal year 2024, sales growth of 4.6% with EPS growth of close to 8%, and the same thing happens in fiscal year 2025. Now, of course, when talking about PepsiCo, we always have to compare it to the Coca-Cola company, but in my opinion, when buying PepsiCo, you're buying a business that is a bit more diversified, right? It's not solely focused on sugary drinks. Of course, it offers Pepsi, Gatorade, Mountain Dew, stuff like that. But as you can see, it also offers you snacks, which is definitely an added value. Now, here you can say, okay, but how does this make this company recession-proof? Well, again, these are things that you go to the store, whether you have kids or whether you're single, doesn't really matter. These are the things that you will buy no matter what. If you want to buy Lay's, some chips, some snacks, soda drinks, you're probably going to buy it either from the PepsiCo company or from the Coca-Cola company. Doesn't matter what macro environment we are in. Now, of course, some people might say, yes, but what about this new movement of people becoming a bit more fit and stuff like that with the Novo Nordisk and GLP-1 or whatever it's called, this new trend of people wanting to eat a bit more healthier, stuff like that. Well, currently I see no indication that this is hurting brands like Coca-Cola or PepsiCo. On the contrary, if we look at the latest inflation number CPI report, we can see that companies like Celsius, like PepsiCo, still have some pricing power. So to conclude, these are the three companies, of course, in a very similar sector, because I do think that this sector has been hit harder than others in 2023 because of the fears of a weak consumer, because of the fear of recession, and also the pricing, the inflation of things like sugar, cacao, and stuff like that have definitely hurt companies like Hershey. But going into 2024, I do think that the risk reward favors the reward here. You're getting very, very stable companies that will provide a lot of shareholder value for the years to come, because you're not buying dividend-paying companies just for a quarter or just for a year. No, you're trying to pick these companies when they're down and hold them for a long, long time and see your dividend payouts increase throughout the years. So that will be it for this video. Of course, do share your picks down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.